Hello, guys. I had to start hunting for the kind of stocks people may look back on and say, I wish I bought that in 2026, knowing what I know about crowded indexes, energy demand, data centers, uranium, minerals, and the way big money quietly moves before the crowd wakes up. I would not begin with the stock everybody is yelling about. I would begin with the plumbing, because most people think the market is about headlines. It isn't. Headlines are usually the smoke after the fire has already started. The real question is where the money is moving before it becomes obvious. And right now, I think one of the most important things happening is not just which company is winning, but which sectors are getting fed while everybody else keeps staring at the same mega cap screen. It is Sunday, April 26th in New York, and I want you to comment what day and date you're watching from. And if you value this type of breakdown, support the channel by subscribing and commenting John A.G. Best below. It tells me you want more work like this. So today we're going to walk through the setup like adults, not like gamblers, not like people chasing a hot ticker because somebody screamed online. We're going to look at the market the way I think it has to be looked at now. Macro first, sectors second, stocks third, because if you start with stocks, you are already late to the thinking. Now let's start with the uncomfortable part. The index is not as balanced as people imagine. When you buy a market cap weighted index, your money does not get spread evenly across every company. The biggest companies get the biggest checks. That means the giants keep getting fed first, simply because they are already giants. That system can work beautifully while the giants are leading. I'm not pretending it can't. It has made a lot of people money. But it also means that what looks like broad diversification can secretly become a very concentrated bet. Recent market research showed the largest handful of companies representing close to 2/5 of the main U.S. index, a level of concentration not seen for generations. So when someone says, I own the whole market, I always want to say yes. But do you understand what part of the market is doing most of the lifting? That is missing. And the machine behind this is enormous. U.S. exchange-traded funds recently held roughly $14 trillion in combined assets. That is not pocket change. That is a river. Every payroll contribution, every retirement account, every automatic buy, every passive inflow, it all has to go somewhere. And because of the rules, a very big chunk goes into the companies that are already massive. Now, does that mean you sell every index fund and run into the woods? No, don't be silly. Index funds can still be useful. For many people, they are still the cleanest long-term core. But if you're trying to find the next place where money may rotate, then you cannot stare only at the index. You have to look underneath it. And here is the subtle part. When the market becomes this top-heavy, the broad index can look healthy, even if the average stock underneath is tired. That can fool people. It makes them think everything is fine because the headline number looks fine, while leadership is narrowing behind the curtain. Recently, alternative weighting and momentum-style strategies have had moments of strength precisely because they were not simply leaning on the same mega-cap crowd in the same old way. That does not mean you abandon the giants. It means you stop worshiping them. A giant company can be wonderful and still crowded. A smaller industrial company can look boring and still be where new money is quietly accumulating. Both things can be true. Markets are annoying like that. So, the skill is not prediction. The skill is observation with discipline. You watch what money is doing, not what your favorite story says it should be doing. That brings us to the weather. The weather today is not the free money party from a few years ago. Inflation pressure is still a thing. Rates may come down in steps, but the world has not returned to zero-gravity finance. Governments are still spending. Supply chains are still political. Electricity demand is waking up. And the AI boom, which everybody thinks lives inside a shiny invisible cloud, actually needs very visible, very expensive, very physical infrastructure. Servers need power. Data centers need power. Power needs generation. Generation needs turbines, gas, uranium, solar, grid upgrades, transformers, cooling, copper, land, permits, and time. The latest energy forecasts show U.S. power demand is expected to keep setting records as data centers and industrial demand grow. That is not a side note. That is the foundation. And one more thing about data centers. The demand is not theoretical anymore. Large AI campuses are being planned with power needs that sound more like small cities than office buildings. Some projects now talk in gigawatt language, and that changes the conversation for utilities, landowners, gas suppliers, grid planners, and equipment makers. That is why I do not treat AI as only a semiconductor story. Semiconductors matter, of course, but after the chip is sold, the facility still needs power. It needs cooling. It needs backup. It needs transmission. It needs a utility willing to serve it. That creates second-order winners. And second-order winners are often where retail investors arrive late because they are too busy staring at the obvious first-order winner. And this is where the first area comes in, energy infrastructure and oil field services. I'm not just talking about the company that owns the barrel. That is the obvious part. I'm talking about the companies that sell the equipment, build the systems, service the machines, handle gas technology, support LNG, maintain the industrial backbone, and make the entire energy chain actually function. During a gold rush, sometimes the person selling the shovel makes steadier money than the person digging the hole. Same idea. One company people watch in this category is Baker Hughes. Again, I am not telling you to buy it. I'm telling you why it belongs on the map. Its own recent filings and updates have pointed to strength in gas technology services, industrial technology, and LNG-related demand. The company has also described a long runway for global LNG demand over the coming decades. And that matters because LNG is not just an energy headline. It is infrastructure, it is terminals, it is compressors, it is turbines, it is equipment, it is maintenance, it is years of physical build-out. This is why I like the picks and shovels angle. You do not need to predict every oil price move perfectly. You need to ask who gets paid when countries decide energy security is no longer optional. Now, there are smaller infrastructure names too, including companies tied to temporary worksite access and industrial project support. Those can be more volatile. Smaller names can move faster, but they can also punish sloppy sizing. So do not hear interesting and translate it into go all in. That is how people turn research into regret. The second area is critical minerals. And yes, I know that sounds boring. It sounds like something a government committee would say right before everyone checks their phone. But boring can become powerful when the world suddenly realizes it cannot build the future without the materials. Lithium for batteries, uranium for nuclear, rare earths for defense and electronics, copper for wires, graphite, gallium, and other materials that normal people never mention at dinner but modern industry cannot ignore. The reason this matters is simple. The digital world still has a physical skeleton. Electric vehicles need materials, grid upgrades need materials, defense systems need materials, AI data centers need electricity, and electricity needs infrastructure, and infrastructure needs materials. Governments are not talking about critical minerals because they are trying to sound clever. They are talking about them because dependence has become a strategic risk. Recent policy moves show the U.S. is still pushing money and attention toward domestic critical mineral supply chains, including fresh funding opportunities and rare earth recovery efforts. That is the point. When a sector becomes tied to national security, the conversation changes. It is not only about price. It becomes about access, reliability, processing, storage, and control. Now, one name in the lithium world is SQM. It is tied to Chile, lithium production, and expansion plans in places like Chile and Australia. Recent company materials point to capacity expansion plans, including lithium carbonate and hydroxide growth targets. But here is where we need to stay honest. A great theme does not guarantee a great entry. Lithium has been through brutal pricing cycles. A company can be strategically important and still have a stock chart that chops investors to pieces. So with something like SQM, I would not only ask, is lithium important? Of course it is. I would ask, is the market rewarding this company right now, or is it still digesting the last cycle? That's a completely different question. Another watchlist name is Uranium Energy. Uranium has gone from forgotten to suddenly important because nuclear power is back in the conversation. AI power demand, grid reliability, energy security, and domestic supply have all pushed uranium back onto the table. Recent industry updates said production began at a South Texas uranium project, with U.S. processing capacity tied to the company's South Texas and Wyoming operations. Again, do not turn that into blind buying. Uranium stocks can be wild. They can look sleepy for months, then move violently, then punish late chasers. So the question is not whether the story is interesting. It is whether the chart, the volume, and the risk make sense together. That is where most people get it wrong. They find a story and forget the trade. Think of every theme as 3 layers. The headline layer is what everyone talks about: AI, energy security, domestic minerals. The second layer is spending. Who is forced to spend because of that theme? Utilities, drillers, data center developers, governments, manufacturers. The third layer is suppliers. Who sells into that spending? That is where energy services, equipment makers, mineral producers, processors, and infrastructure companies start showing up. Most investors buy the headline. The better question is, who invoices the headline? The third bucket is essential minerals and materials more broadly. CMP is one example people track in that area. It is not the same story as uranium. It is not the same story as lithium, but it sits inside the broader world of materials that become more important when inflation, infrastructure, supply chain security, and industrial demand matter again. Recent company updates show management still guiding around its core salt business and margin recovery, which tells you this is a real operating business, not just a buzzword floating around a theme. Now, let me pause here, because this is important. A watch list is not a buy list. Please write that down in big bold letters. A watch list is a hunting ground. It is where you keep names that fit the macro weather and sector flow. You still need an entry, position sizing, a risk plan, and to know what would prove you wrong. If you do not know what would prove you wrong, you are not investing, you are hoping, and hope is not a strategy. Hope is what people call a strategy after they already lost control. So how would I actually approach this? First, map the market like a chessboard. Big tech, energy services, LNG infrastructure, uranium, lithium, critical minerals, gold miners, defense, healthcare, industrials, software, semiconductors, financials. Second, ask where money is improving. Not where the loudest people are talking. Where are charts breaking out? Where is volume showing up? Where are earnings comments improving? Where are backlogs holding? Where are governments directing capital? Where are customers forced to spend whether they like it or not? Third, pick leaders. Not the cheapest junk in a strong sector. Leaders. The companies that break first, hold better, attract volume, and look like institutions actually want them. Fourth, scale in. Do not dump huge money into a new idea you barely understand. Start small, learn the behavior, add only if the thesis and the chart both improve, and fifth, protect yourself. If one position can ruin your month, it is too big. If one headline makes you panic, you sized it wrong. If you cannot sleep, the trade owns you. Keep a little cash for sanity. Cash lets you act when a setup arrives, but too much cash in an inflationary world becomes comfort that slowly leaks value. So do not be reckless and do not be frozen. That is why this framework matters. It gives you something to do besides panic, chase, or wait forever. Once a week, review the map. Which sectors are improving? Which charts are forming bases? Which companies are reporting demand that matches the macro weather? Which names are moving before the headline crowd arrives? It is not complicated. It is work, and that is why most people won't do it. If you're successful, share your success story in the comments so others can stay motivated. Now, let's be fair. This whole rotation idea can be overused. Sometimes people invent rotation where there is only noise. Sometimes a sector runs for 2 weeks and then dies. Sometimes a beautiful chart fails. Sometimes the mega caps keep winning longer than anyone expects. And the hidden opportunity stays hidden so long it becomes annoying. That is why you need humility. The goal is not to predict everything. The goal is to stop being blind. You do not need to catch every move. You need to recognize when the market is no longer rewarding the same old crowd and when a new group starts receiving real money. That is the entire game. Comment below which theme you think is stronger for the next few years: energy infrastructure, uranium, lithium, or broader critical minerals. Because the last big wealth opportunity of the decade may not look exciting at first. It may look like pipes, turbines, grids, compressors, mines, processing plants, and boring companies doing boring work for a world that suddenly needs a lot more physical stuff. And that is usually how these things work. By the time everybody agrees it is obvious, the best part may already be behind you. So build the map, follow the money, respect the risk, and do not confuse a loud stock with a strong sector. This is for education and research only, not personal financial advice. I'm sharing how I think through the setup, not telling you what to buy. Do your own work, use proper risk controls, and never let a good story talk you into a position your portfolio cannot handle.